welcome to the download. I'm your host, Dave Richardson, and we promised we were going to get him back more frequently. And we hate to break promises. My wife would argue with that, but I generally hate to break promises. And so we have got Scott Lysakowski back again, Captain Canada.
I'm okay to be the Canadian representative, but Captain Canada, that's a pretty bold.
Well, but look, you manage Canadian equities.
Sure.
You're from Canada.
Yeah.
Actually, though, here's one thing that's on the other side of the ledger. I don't think you drink a lot of Tim Hortons. So that could
No,
be.
for the YouTube folks at home, I did top up my coffee for this, and look, I don't know if you could see this. This is a vintage. Can you tell by the color
I know.
scheme and so this is a vintage RBC mug, and I'll shout out this is the Whistler Reuse It Center, which is kind of like Value Village, a community-based value village in Whistler, and all kinds of great finds. I got this for 50 cents. You know I'm a big value guy. Got
Yep.
this RBC vintage mug for 50 cents at the Whistler Reuse It Center. So if you're passing through Whistler, stop in. Always a great find in there. But
there you go. Always tips beyond just investing. You get here on the download, and that's one of the reasons why we have Scott on. So Scott, let's since we are going to talk about Canada, we hear a lot of, I don't know, and maybe it's because I'm in the we're in the investment business, and a lot of that news flow is from across the border, and people pay attention to U.S. markets and that. But I hear about these massive U.S. companies announcing their earnings. Canada's a little quieter. Maybe when the banks report, it's something, but we've talked a lot already in various episodes here about what's going on with U.S. earnings and really earnings all around the world. And again, if you subscribe to the podcast, you know Scott's on regularly. He did a great synopsis of what's going on with profits across many markets, not just Canada, in his last appearance about a month ago. So subscribe, follow us on wherever you get your podcasts, and subscribe on YouTube. But Scott, the profits this quarter, you'd have to just say once again, like, big, huge check mark. Not bad at all, eh?
that's right. Earnings season is always a busy time. Lots of news and information sort of sometimes it's too much news and information hitting our screens and our inboxes, and lots to sort of take in. But it is an important time because, as we all know, when companies report their earnings, it's their time to share sort of what's been happening in their business in the most recent quarter, also to give updated forecasts on what's happening in their business and how things are looking into the future. There's a time for a conference call where analysts can ask questions about the business. There's opportunities for us as investors, and a lot of times large investors in some of these companies, to have a follow-up conversation with management on our own to discuss the quarter and the outlook. So it's a lot of information. I would argue, yeah, a little bit of too much information, but it's a great opportunity sort of to reset expectations. And then, of course, there's the market reaction. And so we kind of think about earnings in a couple of ways. One, we have to think about the reporting and earnings for a quarter that's already happened.
Yes.
And so that information is sort of already in the rear view mirror. And as we've just discussed many times, the stock market is looking forward. So sometimes companies have great quarters or decent quarters, but the outlook changes. Or it's not just about was the quarter good? It was the quarter good enough to meet expectations? So what were the estimates, and sort of what were people expecting going into that quarter? And sometimes when those things are misaligned, whether the company misses what people expected, or people expected them to have a good quarter and it was good, but it just wasn't as good as expectations, the stocks can have a bit of a reaction. And as you're probably aware, and perhaps our listeners are as well, there's a lot of new market participants, and I thought you and Stu had a great discussion about levered ETFs and things like this.
Yeah.
So there's a lot of different participants, and so when stocks have moves, those moves can be very magnified. But sort of dialing down some of that noise, some of the things that we focus on in the quarter is that opportunity to get an update from management and things like this. But I thought I'd just maybe share some stats. I love the numbers.
Yeah.
I never met a number I didn't like. So in Canada, for the TSX, we've had about three quarters, 75% of the market has reported. The banks are the big ones. They're coming up in the
Sure.
next couple of weeks. So there's probably remaining. But, I'd say outside of the banks, most of the companies have reported their Q2 or whatever fiscal quarter they were reporting. And some interesting numbers come out of it. So about 60, just over 60% of companies that have reported their earnings so far have beat the consensus estimates. And so that's a good thing.
Yeah.
And
Yeah.
the median beat has been by around 3 or 4%. So they've been beating, but they haven't been like blowing them out on average. And so that's one of the things we look at really closely. And we look at the numbers. We could look at a year-over-year number, and that's a good sort of gauge of how things are going in this company year over year, and building on where we were last year. And there's some really interesting sort of takeaways from that. And one is that earnings are up 32% year over year, which is just an astounding number. Like, I
Astounding.
don't think anybody goes into the year going, yeah, I think TSX earnings are going to grow 30% this year. Now, there's a bit of puts and takes, because if you think about in the resource sector, energy and materials, and it's not just gold. So energy, we know the oil price has been up a lot given the things that
Yeah.
have been happening in Iran, geopolitically. And if you think about where we were last year, oil prices were a lot lower. So energy earnings are up over 100% year over year.
Yeah.
So that's not really something that we would expect to persist. Materials also up, 50% year over year. And it's, the gold price, I think we talked about it last time. The gold price has gone up and come back down, and it's sort of below where expectations are, but still year over year, the gold price is higher, and therefore gold earnings are up
Yeah.
50%. Base metals, the other part of the materials sector, the other mining, so things like copper and things like this, those earnings are up over 100% as well. So
Wow.
those are not things that I would expect to continue, because you're thinking about next year. We have to think about where are earnings going to be relative to an $80 oil price environment. There's some interesting takeaways here, and I want to spend a minute on operating leverage in a second, but we also think about the estimate revision. So when you think about, there's sort of three components of an earnings report. What did they deliver? How did that look versus expectations? And then what are analysts now going to do to their estimate forecast going forward? So, if you had a company that beat expectations that were already high, and their outlook was good, but maybe not, you know, higher than what people expected, you actually might see estimates stay flat, or even estimates revise a little bit
Yeah.
lower. And what we're seeing, not surprisingly, is estimate revisions in there's a bit of a mixed bag. In the energy sector and the materials sector, we're seeing some negative estimate revisions
Yeah.
because the oil price has come down from where we were previously. So analysts are sort of calibrating their numbers lower. Same within the gold sector. But outside of resources, we're actually seeing positive estimate revisions. And that's a good thing. I think the last time I was on here, I said, going into earnings for the TSX, you're going to get a bit of noise in oil, you're going to get a bit of noise in gold as these things are up, down, lots of volatility there. But it's kind of like the rest of the market is sort of chugging along nicely. And that's where I probably want to spend a bit more time today, and discussing a concept of operating
Well,
leverage.
Scott, maybe just before we go
Sure.
there, when was the last time you recall seeing earnings this powerful? And again, we'll cut out as you say, energy and gold, and because they're gonna bounce all over the place based on the underlying commodity, and you'll see these big moves up and down in terms of
Yeah.
their profits. But just again, broad based. And it's really, as you said, astounding was the word you used. And when was the last time you saw anything like this, or have you
You
seen
know,
anything a whole lot like this?
yeah, that's a good question. I would say, like, coming out of things, periods, like, I guess the thing that comes to mind was, coming out of the pandemic, where you
Sure.
had, especially as you had companies, managing their cost structure a little bit better, sort of through the pandemic, and then you getting that reopening trade. We just said, like, when people can kind of go out and do things again, there were certain parts of the market and certain businesses that were getting lots of activity because people were at home with nothing to do. If you think about exercise equipment and things like
Yeah.
this.
Yeah.
But the other parts of the business that were sort of a little bit more impacted by people being home. So that's something that sort of jumps off the top of my head. But yeah, you get these moves in commodity prices, and that's going to really sort of drive the numbers a little bit more wildly. But if we think about the cyclical parts of the market, and outside of resources. So if we go X resources Canada, the cyclical parts of the market are doing better than the more defensive sectors. So we're seeing positive earnings growth, positive estimate revisions in things like industrials, discretionary, financials, and technology sectors. And we're seeing, that's what I was sort of referring to as, like, I call that the middle of the market, but maybe it's not the middle, maybe it's just the rest of the market.
Yeah.
This concept of, and that's where you see this idea of positive operating leverage. Like, in the quarter, revenue was up 13%, or in the companies that have reported earnings so far, revenues were up 13%, but earnings were up 30.
Yeah.
And so that's a great example. In the U.S., it's a very similar. We're a little bit more through the earnings cycle in the U.S., but similar type of numbers there, where year-over-year earnings growth north of 30%. 85% of the companies have beat. The median beat is around 5 or 6%. And you same thing, you're seeing revenue growth of 13%, but earnings growth north of 30. And this is this concept of positive operating leverage. I think we talked about it a little bit with the banks, but we see it in a number of sectors. We see it, in more kind of more, I'll call them cyclical businesses, but more, industrial types. The rails have reported they showed really good positive operating leverage. And that's something that's really, really important, that you get more earnings growth as incremental revenue gets added to the equation. And that's something that's a real benefit to shareholders, particularly in industries and sectors of the market that are more cyclical, more tied to economic activity. And I was trying to think about, how do I describe this? I was, had some family visiting, or spent the weekend with my family, and I was explaining to my brother-in-law how positive operating leverage works. Now, operating leverage works positively and negatively, but we'll stick to the positive. And then I was
By
thinking about,
by
this
by the way, Scott, that just sounds like a fabulous family gathering. I'm glad I wasn't invited.
talking
Come
operating
on,
leverage.
come on over and watch the ball game. Come on over and talk about operating leverage. I'll give you a primer on that.
Yeah,
But it
yeah.
makes for a great podcast, Scott. So fire away with your example.
Well, usually when I get going on it, my wife would give me a look of like, nobody really cares about this, but he seemed engaged, so maybe
Yeah.
he was just humoring me. So I was thinking about, how do we explain positive operating leverage to, the brother-in-laws and the mother-in-laws and our moms. And I thought about, well, what if we just stripped it down to the most basic business example that we can? Let's think lemonade stand. So I'm thinking about a young Dave Richardson out on the driveway with the table set up and selling lemonade. I don't know. Back then, Dave, was it pennies a glass? Who knows?
Oh yeah, yeah. Geez, it
Anyway,
was
so
not
lemonade.
yeah, not it was not that lucrative, but I knew about operating leverage back then. So you're going to
Okay,
see
so
why
let's think about
I
our
did so
basic
well.
lemonade
Yeah.
stand. And so you have, in a business, you have two types of costs. You have fixed cost and variable cost. So in a lemonade stand, your fixed costs are fairly low. You borrow the table from mom and dad, and really your only cost is the variable cost. Water, that's pretty free. Lemons, if you're going freshly squeezed, maybe a little bit higher end, but if you're just going with the mix, it's pretty cheap. So every glass has probably got, a couple cents of variable cost, and then the rest is profit. And so when you're thinking about positive operating leverage, it really applies to businesses that have some fixed cost component to it. So let's say we've got a lemonade stand and it's going well. We're in these hot days of the summer and it's going well, and somebody goes, "Hey, you know what I'd really enjoy is one of these sort of like frozen, daiquiri style lemonades,
Mhm.
non-alcoholic, of course."
Oh,
And you say, "Wow, that's pretty cool." Then you go and young Dave Richardson goes into, I guess it wouldn't be the internet, it would be the Sears catalog, and looks up this frozen lemonade machine. And let's say it's keep things simple. Let's say it's $100. And you're like, "Wow, if I got this frozen lemonade machine and I spent $100, I could probably sell my lemonade, instead of 50 cents a glass, I could sell it for $1 a glass." And I think that's a really good idea. And so even though your variable cost is still water and lemonade mix, so it's still quite low. Now you've added a fixed cost component of this. You got to pay back. Maybe you have to go borrow money from mom and dad and say, "Can I borrow $100 to get this frozen lemonade machine?" And so now, but you got to pay them back. And so you kind of think about the first. Let's just keep things really simple, and let's just say that you're making 50 cents a glass. So your first 100, or I guess how how many glasses would you have to sell to pay back the cost of the machine? And so you're not really making any earnings because you're still paying off the cost of your machine. But at that point where the cost of the machine is paid off, that next glass is pure margin. And so that's something that we see in the economy. We see it in sort of stocks. If you think about a railway company, or we were looking at a trucking stocks earnings this quarter. They grew their revenue 7%, but their earnings grew 50%. And so there's this massive amount of operating leverage because they're increasing price, they're getting more volume as demand is strong, and there's not as much trucking capacity in the industry anymore, or currently, and they're getting increased volume, higher prices, and it's not really coming at any incremental fixed cost. Their fixed costs are covered. And once you hit that positive operating leverage, a lot of that incremental revenue comes at a really high margin. Same thing for a bank. If you thought about whether it's net interest margin or capital markets revenue, if it's a really busy quarter or year for the capital markets business, they might be hiring more people, but you're really getting a lot of this revenue over a fairly fixed cost base. So we're starting to see that sort of really kind of show itself in these earnings this quarter. This could also be a really important thing to think about as we move forward into a world where the use of AI is driving more productivity, more efficiency within businesses. Maybe businesses are using AI to get more revenue without really taking on a lot of additional costs. So this growth in revenue will come at a really, really high margin, and that'll be a really big benefit to existing shareholders, as that incremental revenue comes at a high margin that leads to increased earnings, free cash flow, and ultimately flowing back to shareholders. I hope our little lemonade stand example lands with the audience, but I think it's a really important thing to point out.
The other older people like myself who are listening may be somewhat offended by a couple of your comments, but no, it was a solid example. Solid example, because it was back in the old days that I was doing a more traditional lemonade stand. So you did nail it. But I think that was where I was going with that question earlier about where have you seen earnings like this before? Because it leads into this whole idea of artificial intelligence and how much of an impact, and you kind of addressed it, but how much of an impact do you think this is going to have over an extended period of time instead of just what we're seeing over a handful of quarters? Is this a story that's going to really play out over a number of years, which ultimately leads to some of the things we've talked about with some of the other managers, and you're involved in investing in some of these companies too, is all this capex that these companies are spending, is it going to produce a return down the line? Maybe we're seeing it already in the companies that are using the AI, which should promote the use of AI and then trickle down. And do you see where I'm going with this?
Yeah.
What do you see that as part of this bigger picture narrative of what's going on, driven by what's going on with AI?
Potentially, I would hesitate to attach what we're seeing today to AI just yet. Although I'm sure there are some examples of it being used. There is some limitation, right? If we at some point, in order to kind of keep your revenue growing, you may need to add incremental fixed costs. So we may need to, if things are growing really well, and if we want to grow our revenue in our lemonade stand another 10 to 15%, we might need to get another lemonade machine. We might actually need to open a new location. Send your younger brother down the road. Hey, take a table, borrow $100 from mom and dad, get another frozen machine. We're going to expand. So you you will be growing your revenue, but it will come with additional fixed costs.
Yeah.
Same thing, this trucking company, at some point they may need to sort of expand, get more trucks, get more people, need more training for more drivers. May come with more investment, and that investment will have a fixed cost component to it as you're trying to pay that back. So I would say there are sort of limitations, but it's usually at these things when you're kind of emerging out of, and we're not emerging out of a weak economic cycle, but we had a
Yeah.
period where people were somewhat concerned about trade and tariffs and what's the future going to look like, and there might have been a little bit of hesitation on growth and capital investment, and what we've seen is that despite all the noise from this trade, and we're not out of the woods yet, and there's always something, there's a few things happening. The next couple of weeks, months are pretty big for Canada on the trade file. So I
Yeah.
don't want to say we're out of the woods because there's certainly some surprises that could come down the pipe. But it's this idea that people have kind of hesitated, and we've seen economic growth continue, or the economic activity continue, just to kind of trundle along in a positive direction. So you're getting that, they haven't invested, but we're getting that top line revenue growth. So you're seeing the positive operating leverage. There is a limit to that. So at some point we will have to reinvest and add to the fixed cost base, which would be a good thing because you're driving even more revenue growth. Um, as it relates to AI, there's sort of two things I would observe, and I am by no means an expert on AI. And we're users and we're heavy adopters, and it's really helping us get through earnings seasons. I'll tell you that. But in terms of a hyperscaler and where all the capex is happening, this is not sort of my area of expertise. But as an observation, we've seen all these huge capex numbers, and the biggest question in the market was, what is the return going to be? Is it going to
Yeah.
be, is there going to be a return? Is it going to be big? Is it going to be small? And when are we going to start to see it? And one of the things that sort of has really impressed me, and we just got out of our quarterly strategy sessions as a group at GAM in this last week, and I think people walked out of the room out of this 2-day session going, um, really sort of impressed with the rotational aspect and strength of equity markets, and that rotational aspect adding to breadth. And I think I've mentioned this in the past. When we're thinking about equity market strength, you want to look at the returns and think about, where is the return coming from? Is it coming from a small number of stocks, a small number of sectors? And you want to see breadth. You want to see strength from a wide number of stocks and a wide number of sectors. And so through the earlier part of this year, we saw the big sort of hyperscaler companies spending all this money in the stocks, and the stock market was a little bit hesitant of where this was going. They weren't going down, but they were kind of moving a little bit more sideways. And they were saying, where is this return going to come from? And then what we saw in this quarter, and it was just a glimpse, but I think the market sees a glimpse of something and says, oh, I think we could see a lot more. Starting to see early signs of that sort of the payoff, or starting to see some of the early returns of that capex getting spent. And of course, the stock market, as it looks forward, says if there's a glimpse, there potentially could be more in the future. And they bring that forward, and they bring that forward basically by the share prices going up. They're bringing that growth forward, expanding the multiple, stock prices are going higher. And that really led a really positive rotation into the market, sort of back into these. And these are the big bellwether names in the US market. So that really took the markets to new highs. And then you've had sort of the rest of the market performing well, as we talked about, similar in Canada, industrials, discretionary, technology, these sorts of stocks. And then you sort of have this reemergence of the big stocks sort of accelerating higher as well. So I'm not trying to dodge the AI question completely, but I think what the market is saying is, like, I think there's something here, and we'll see where this goes. The problem I think, if I were to worry about something, is that is back to this expectations game. What are the expectations? So if you're thinking about the U.S. is showing strong earnings growth, trading at a fairly healthy valuation multiple, so that and even as these big stocks accelerate, the market is expanding the valuation of these stocks as well, so bringing some of that growth forward. So the expectations for future earnings growth go even higher. And then you also have this concept of, like, we're trading at a fairly robust valuation on fairly robust earnings growth. And the other thing that we have to think about is that current operating margins, profit margins across, if we just use the S&P
Yeah.
500, are at their highs. And Stu has pointed this out many times. And so when you think about that, you say, wow, okay, this AI, I could see the productivity enhancements, the productivity improvements from future in the future as we drive more revenue growth and optimize and are able to grow our businesses without adding incremental costs because we've sort of outsourced it to AI capital investment. That would be really good for margins, but it would basically have to take current margins that are already high and make them even higher.
Yeah.
So I would hesitate to sort of jump into that AI is going to change the operating leverage for the S&P 500 or for equity markets going forward into that bucket just yet. Especially given that we are sort of on the higher end of a lot of these things, earnings growth, margins, and valuation. So there could be a wobble in the near term or like at some point over the next even couple of quarters, but this idea that you could continue to see, we can actually think of a scenario that would be, I wouldn't put it in my base case. I'd probably put it more in a bull case scenario where AI investment leading to, even if it's just optimization of
Yeah.
existing capital
Yeah.
investment, driving revenue growth without any incremental margin, or you're making some AI capex investments, but you're also driving a lot of additional revenue from that, and then again, that's going to have some positive operating leverage as well. So it's something that we're going to stay really, focused on as we companies report quarters over the next, probably, many even years to come, but certainly over the next couple of quarters, we're going to keep looking for this evidence of the return on capex from AI investment from the big hyperscalers, and then also the productivity enhancement and margin improvement from the users of AI, thinking just sort of industrial companies, discretionary companies, using AI to drive and enhance their revenue growth with attractive margins as well.
And that's what's so fun about markets, because there's going to be some people who are of the opinion that we're going to see all of this continued productivity growth, and it's going to lead to better operating margins and bigger profits across a broader range of companies. And there's a whole bunch of other people who think, this is just that we don't see any signs that this is going to produce anything. They're just throwing money down a hole, and people can bet either way with buying and selling stocks every single day. I did want to get back. I've just been thinking. We talk about breadth quite a bit on this podcast with the various guests that we have on, and I've always tried to think of what would be a good way to sort of lay out the concept of breadth. And your lemonade stand gave me an idea. So if you think about it, so say you had three kids,
Mm-hmm.
right, and they all open up a lemonade stand, right? So they're all right, and you're a parent, you love all your kids the same, and one kid makes $100 the first day, and the other two both make nothing. And of course, they come home that the two that made nothing are kind of sad or disappointed, or and what I'd rather see as a parent, right, is maybe one of them makes $50, but the other make like 40 each, right? So I'd rather have breadth. I'd rather have everyone doing well than just one doing well and the rest
Mm-hmm.
not doing as well. And your family is kind of your extended family is the Canadian stock market, so that's why you like your all of your family to do well profit wise, operating margin wise, and when there's breadth, everyone's doing well in your family, Scott.
That's exactly right, and especially when you think about in Canada, this is something that Canadian investors are really faced with. Other markets are a little bit more broadly diversified across sectors, but in Canada, there's going to be volatility in the sort of more commodity resource-driven sector. So you
Yeah.
just live with that. Sometimes it's exceptional, and you look at these 100% year-over-year earnings growth numbers, and you're like, okay, I don't actually think it's 100. It's just a big level up from last year. But it's really that sort of the other parts of the market, technology, industrials, consumer. And when you see that those sectors are growing their earnings 10 plus percent, you're seeing them beat earnings, you're seeing estimate revisions there. That's a really good sign of the breadth of the earnings. The other way we measure it is in just the behavior of the stocks. We could say, oh, the TSX is up 13% year to date or 15% year to date
Yeah.
when I look at my screen, and you say, okay, that's great. But how many of the stocks are up and how many of not every stock is up? And so one of the measures we look at, and it was really important to focus on it even this last couple of weeks as we sort of, I talked about this dynamic where these big U.S. stocks started to accelerate, and you see market reaching new highs, and we look at something that we call the advanced decline ratio. So how many stocks are
Yes.
going up relative to how many stocks are
Yep.
going down. And so what you'd want to see if you see a stock market, you see the stock market acting well and making new highs, you want to see that advanced decline line going up as well. So it means the stock market's going up and it's not just a couple big
Yeah.
stocks driving the bus. It's actually the stock market's going up and you're seeing more advancers than decliners. So we saw that. That's a good signal of breadth. And the other one, which I think we've talked about and we have explained it, so we won't go through the explanation, but how many stocks are above their rising 200-day moving average?
Yes. Yep.
And so you think about those stocks are, they're high and they're higher than they have been in the last year, and we're starting to see more of them get above the sort of the last year's average price. So that's like a really important signal of breadth. But you're right. You want to kind of see, you will love to see the stock market go up, but you want to see a wide amount of participation in stocks that are going up. That's that breadth feature that we're talking about.
And just to finish up, Scott, you said it. You finally, I think you're going to finally understand now. You said that managing money in the Canadian market is hard because of all of this up and down and fluctuation of the resource sector, which is such a big part in Canadian. That not as much broad diversification, not as many big industries across Canada. That makes managing money in Canada hard. So if you're a great Canadian money manager like Scott Lysakowski, you're a superhero. You're Captain Canada. That's my argument for it. You
All
can
right.
maybe you like it more now. No, you don't. You look frustrated.
I'll take it.
And
I'll take it. I'm taking this Captain Canada on the road. We're going on vacation next week, so I'll make sure I put a little Canadian flag on my backpack so people know where I'm from.
always there you go. Where what have we got right there? There's my Canadian flag always with me. My
Oh,
maple
lovely.
leaf. Scott, thanks again. Always fun catching up with you. Have a great vacation with the family, and we'll catch up with you maybe about a month or so.
Great. Thanks, Dave.
This podcast has been provided by RBC Global Asset Management, Inc., RBC GAM, and is for informational purposes as of the date noted only. It is not intended to provide legal, accounting, tax, investment, financial, or other advice, and such information should not be relied upon for providing such advice. RBC GAM takes reasonable steps to provide up-to-date, accurate, and reliable information, and believes the information to be so when provided. You should consult with your advisor before taking any action based upon the information contained in this material. All opinions constitute our judgment and are subject to change without notice. The information presented here is provided in good faith without legal responsibility. RBC GAM reserves the right at any time and without notice to change, amend, or cease publication of the information.